Okay, this chapter and the next chapter, we discuss some of the data that economists and policymakers use to monitor the performance of the overall economy. These data reflect some economic changes that macroeconomists try to explain. This chapter considers gross domestic product, which measures the total income of a nation. GDP is perhaps the most widely watched economic statistic because it is thought to be the single best measure of a society's economic well being. And the questions we seek answers to include: what is gross domestic product or GDP? How is GDP related to a nation's total income and spending? What are the components of GDP? How is GDP reflected or corrected for inflation? Does GDP measure society's well being? So, two branches of economics: microeconomics is the study of how households and business firms make decisions, how they interact in markets. Macroeconomics study of the economy-wide phenomena, including inflation and unemployment and economic growth. So, income and expenditure. Gross domestic product or GDP measures total income of everyone in the economy. It also measures total expenditure on the economy's output of goods and services. And income really equals expenditure for the economy as a whole because every dollar a buyer spends is a dollar of income for the seller. Let's revisit the circular flow diagram that we saw earlier on in the earlier chapters. It's a simple depiction of the macroeconomy. It illustrates GDP as spending, revenue, factor payments, and income. Preliminaries here: factors of production are inputs like labor, land, capital, and natural resources. Those are the means of production. Factor payments are payments to the factors of production, e.g., wages and rent. So this is what the circular flow diagram look like. The two institutions are households and business firms. Households are on the supplying side of resources. So households own the factors of production and they sell or rent them to firms for income. But they also buy and consume goods and services produced by the farms. On the other hand, the farms are on the buying side or the demand side of the factors of production. They use the factors of production to produce goods and services, and they sell those goods and services to the household. The two institutions interact in markets. One is the factor markets, where households trade land and labor and capital for income. They supply resources or factors of production to business farms, and business farm pays for them. So the green arrow is the dollar arrow. Wages, rent, or profit is called the cost of production. And what is a cost to business farms is an income to households. The two institutions also interact in the market for goods and services, where, remember, farms produce the goods and services. They sell those goods and services to the household in the goods market. And households spend, that's consumption spending, on goods and services, and that same dollar ends up in the business farm as revenue. That's the circular flow model. It's a very, very simplified model. It omits some very important institutions like government, Government collects taxes and buy goods and services. Government interact with both households and business, but it is omitted from that model. The financial system is not included in that model. The purpose of a financial system is to match savers' supply of funds with borrowers' demand for funds or for loans. That's the function of the financial system. The foreign sector is also excluded from this simple circular flow model. Trade in every nation trades with other nations. They trade goods and services, financial assets, and currencies with the economy's residents. Okay? So, gross domestic product, we are going to define gross domestic product or GDP as a market value of all final goods and services produced within a country in a given year. Market value is highlighted here because goods are valued at their market prices. So all goods measured in the same unit. For example, in the United States, it is dollars. Things that don't have a market value are excluded from GDP, like households you do for yourself is not included. It has to be traded in the marketplace to be a part of GDP. All means all goods and services. GDP includes all items produced in the economy and sold legally in the markets. GDP excludes most items produced and sold illicitly in illegal transactions are not included in GDP. It also excludes most items that are produced and consumed at home. Okay. Final means final, intended for the end user. Intermediate goods are excluded from GDP. Intermediate goods are goods used as components or ingredients in the production of other goods. GDP only includes final goods. They already embody the value of intermediate goods used in their production. Um, Goods and services. GDP includes tangible goods like DVD, mountain bikes, beer, and intangible services like dry cleaning, concerts, cell phone services. Okay. GDP includes currently produced goods, not goods produced in the past. Current production is what is included in GDP, and it is to be within a country. GDP measures the value of production that occurs within a country's borders, whether done by its own citizens or by foreigners located there. In a given year, usually a year or a quarter, 3 months. Okay. Recall GDP is total spending, and the four components of GDP are consumption spending, C, investment spending, I, government purchases, G, net exports, and X. These components add up to gross domestic product or GDP, which is sometimes denoted as Y. So Y equals C plus I plus G plus NX, consumption plus investment plus government plus net export. Consumption is really total spending by households on goods and services. Okay, there's a note here on housing costs, how housing cost is computed. For renters, consumption, C, which is consumption, includes rent payments. For homeowners, C includes the imputed rental value of the house, but not the purchase price or mortgage payments. Not included in C are purchases of new housing. Investment, second component, is total spending on goods that will be used in the future to produce more goods and services. Business capital, business structures, equipment, and intellectual property products, residential capital, landlords' apartments, apartment buildings, homeowners' personal residence, inventory accumulation, that's goods produced but not yet sold. It's important to point out that investment does not mean the purchase of financial assets like stocks and bonds. Government purchases all spending on goods and services purchased by the government at the federal, state, and local levels. It excludes transfer payments such as Social Security or unemployment insurance benefits. They are not purchases of goods and services. Net export is calculated as exports minus imports. Exports, which is foreign spending on the economy's goods and services. Imports are the portions of consumption, investment, and government that are spent on goods and services produced abroad. Adding up all the components of GDP gives Y equals C plus I plus G plus NX. GDP and its components, 2015, Y was 17,947 billions, and that is the GDP. Consumption was 12,272, which was 68.4% of GDP. Investment spending, which 3,021, was 16.8% of GDP. Government, 3,183 billion, was 17.7% of GDP. Net exports was minus 529, which was 2.9% of GDP. Negative just means that we run a trade deficit. On a per capita basis, that is GDP divided by the population of the United States, was 55,426 per capita. Per capita consumption spending was 37,899. Investment on a per capita basis was 9,330. Government spending on a per capita basis, 9,830, and net exports was negative 1,634. Active learning. In each of the following cases, determine how much GDP and each of its components is affected, if at all. Number A, Debbie spends $300 to buy her husband dinner at the finest restaurant in Boston. Number B, Sarah spends $1,200 on new laptop to use in her publishing business. The laptop was built in China. Number C, Jane spends $800 on a computer to use in her editing business. She got last year's model on sale for a great price from a local manufacturer. Number D, General Motors built $500 million worth of cars, but consumers only buy 470 million worth of them. Now, look at the answers. Debbie spent $300 to buy her husband dinner at the finest restaurant in Boston. That goes to consumption component, and so consumption goes up by 300, GDP goes up by 300. Sarah spent 1,200 on a new laptop to use in her publishing business. The laptop was built in China. Here, investment goes up by 1,200, net export fall by 1,200. That was an import, so the dollar goes to China. That means net export falls. Number C, Jane spends 800 on a computer to use in her editing business. She got last year's model on sale for a great price from a local manufacturer. Current GDP and investment do not change because the computer was built last year. GDP only includes current production. Number D, General Motor builds 500 million worth of cars, but consumers only buy 470 million. That 470 is consumption spending, so consumption increases by 470. The remaining 30 goes to inventory, so inventory goes up by 30, and GDP goes up by 500. Real versus nominal GDP. Nominal GDP is valuing GDP or valuing output using current prices, and it is not corrected for inflation. Real GDP values output using prices of a base year, which is corrected for inflation. For the base year, remember that nominal GDP is always equal to real GDP. So here is an example. Uh, 3-year production from 2014, 15, and 16. Compute nominal GDP for each year. Remember, nominal GDP is computing output using current prices. Here, output is pizza and latte. And for 2014, it is 10 times 400 plus 2 times 1,000. That is 6,000. For 2015, is 11 times 500 for pizza plus 250 plus times 1100, and that would be 8,600, 8,250 for 2015, and 2016 was 12 times 600 plus 3 times 1200 for a total of 10,800, and we calculate the increase. Percentage change is simply 8 for between 14 and 15. The percentage change was 8,250 minus 6,000, divided by 6,000, multiplied by 100, and that is how you get 37.5. And between 2015 and 2016, the percentage change, which is 10,800 minus 8,250, divided by 8,250 times 100, you get 30.9%. That's the percentage increase from year to year. Let us now compute real GDP. Remember, real GDP is computed using base year prices corrected for inflation. So here, the base year is 2014. So all prices will be fixed at $10 for pizza, $2 for latte. So 2014, 10 times 400, 2 times 1,000, you add the two, you get 2,000. That is real GDP. In 2015, you value 2015 production at 2014 prices. So 500 times 10 plus 1100 times 2. That is how you get 7,200. And 2016, production was 600, you value it at 10. So 600 times 10 plus 1200 times 2, and that's how you get 8,400. So these 6,000 in 2014, 7,200 in 2015, 8,400 in 2016. That is real GDP. We have corrected for price changes. Okay. So if you calculate percentage increase between the 2 years, 2015 and 2014-15, the percentage increase is 20%. 2015, 2016, percentage increase was 16.7, a more realistic number. This is what is usually reported as economic growth because it is corrected for price changes, corrected for inflation. Okay. In each year, nominal GDP is measured using then current prices. That is how we got these numbers, nominal GDP. Real GDP is measured using constant prices. In here, we calculated real GDP by holding the base year at 2014. And when we calculated the percentage change, nominal GDP increased from 14 to 15 by 37.5%. From 15 to 16, it increased by 30.9%. Real GDP, as we have seen, increased between 14 and 15 by 20%, and between 15 and 16 by 16.7%. The change in real GDP is the amount that GDP would change if prices were held constant. So there is zero inflation. In other words, it is controlled for inflation. Hence, the real GDP is corrected for inflation. The GDP deflator. The GDP deflator is a measure of the overall level of prices. The formula for calculating the GDP deflator is nominal GDP divided by real GDP times 100. It measures the current level of prices relative to the level of prices in the base year. And it measures the economy's inflation. It is used to compute the economy's inflation rate. Okay. Compute the percentage increase in GDP deflator from year to year. So to calculate the economy's inflation rate is to calculate the percentage change in GDP deflator. So example here, compute GDP deflator in each year. Okay. The GDP deflator is nominal GDP divided by real GDP for year 2014. Nominal GDP divided by real GDP times 100. So GDP deflator is 100 in 2014. In the base year, GDP deflator is always going to be 100. Okay, for year 2015, it is nominal GDP 8250 divided by real GDP 7200, multiply by 100, and you get 114. And year 2016, GDP deflator is 10,800 divided by 8400, multiply by 100, and you get the GDP deflator for 2016. And this is what we use to calculate the price changes or the inflation rate. Okay. So between 14 and 15, the inflation rate was 114.6 minus 100 divided by 100. So the inflation rate was 14.6%. Between 15 and 16, the inflation rate was 128.6 minus 114.6 multiplied by 100, you get 12.2%. So we use GDP deflator to calculate inflation rate. Active learning. Use the above data to solve these problems. A. Compute nominal GDP for 2014. B. Compute real GDP for 2015. C. Compute GDP deflator for 2016. Answer. Nominal GDP for 2014. You look at 2014 figure. So it is 30 times 900 plus 100 times 92. That is nominal GDP, 46,200 nominal GDP for 2014. Compute real GDP for 2015. Now remember the base year is 2014. So we are going to value 2015 production using 2014 prices. So we have 1,000 times 30, 1,000 times 30 plus 200 times 100. That would be real GDP for 2015. And compute GDP deflator for 2016. Remember, GDP deflator is nominal GDP. You first calculate the nominal GDP, which is 36 times 500 plus 100 times 205, which is 58,300. And then you calculate the real GDP, which is 30 times 1050 plus 100 times 205, and that is 52,000. And then the GDP deflator, which is nominal GDP divided by real GDP, that is where you find 58,300 divided by 52,000, and you multiply by 100. And so the GDP deflator is 112.1. Okay. GDP and economic well-being. Real GDP per capita, which is the main indicator of the average person's standard of living. But GDP is not a perfect measure of well-being. And Robert Kennedy issued a very eloquent yet harsh criticism of GDP. Senator Robert Kennedy, 1968. This was a statement by Senator Kennedy. Gross domestic product does not allow for the health of our children, the quality of their education, or the joy of their play. It does not include the beauty of our poetry or the strength of our marriages, the intelligence of our public debate, or the integrity of our public officials. It measures neither our courage, nor our wisdom, nor our devotion to our country. It measures everything, in short, except that which make life worthwhile. And it can tell us everything about America, except why we are proud that we are Americans. Okay? So, but GDP also has value still. That's what Kennedy pointed out was the limitations of GDP. But GDP does not value the quality of the environment. It's excluded. That's the limitation. We don't make allowance for the environmental degradation. GDP does not consider leisure time. GDP excludes non-market activities such as childcare that the parents provide at home. GDP does not show an equitable distribution of income. You live in a country where some people are very, very rich, they're billionaires, and some people are so poor they're homeless. Then why do we care about GDP with all these limitations? This is why we care about GDP. Having a large GDP enables a country to afford better schools, cleaner environment, healthcare, and the rest. Many indicators of the quality of life are positively correlated with GDP, for example. GDP and life expectancy. You'll find that countries with high GDP, this is on the horizontal axis, you move on this side, high GDP also corresponds to high life expectancy. You'll find that in the United States, with high GDP, Germany has high GDP, Japan has high GDP, average life expectancy is above $75,000. And countries that are poor, that low GDP, there is also low life expectancy. There's something good about GDP. GDP also is correlated with average years of schooling. Okay. Countries with high GDP also have high literacy rates. The average schooling in the United States, Germany, Japan is about 12 years of education. And whereas the average uh, years of schooling in low GDP countries like Pakistan and India is about fourth or sixth grade. uh, GDP and overall life satisfaction. You ask the ordinary person on the street how satisfied are they with their life in their country, and you'll find that most people in Japan, Germany, and the United States are generally very satisfied with their lives on a 0 to 10 measure. United States about 7 or 8, and Japan is just as high. You ask an average person in India or Bangladesh how satisfied they are with their lives, about 5 or 6. India, Bangladesh, and Nigeria. Okay, so let's look at the summary. Gross domestic product, or GDP, measures a country's total income and expenditures. The four spending components of GDP include consumption, investment, government purchases, and net exports. Nominal GDP is measured using current prices. Real GDP is measured using the prices of a constant base year and is corrected for inflation. GDP is the main indicator of a country's economic well being, even though it is not a perfect measure. And that is chapter 23 or chapter 10 in your split edition.